Student loan issue used to be a hot topic just for 20 and 30-year-olds, recent college graduates. But that is starting to change where pre-retirees, people in their 40s, 50s, maybe even 60s that are still dealing with student loans. So what happened?
Well, education prices skyrocketed. There's a lot of things that happened, right? I would say 35 to 55 kind of folks went through, they remember 2008. Like the Gen Z, even like younger millennial crowd, they have no memory of that. But we see it all the time. I saw it a lot more back when I first started, but people would go, oh shoot, the economy is in shambles, I need to go back to school. And so a lot of 20-somethings at the time went back to school to get more advanced degrees. And because the government put no caps on the cost of education and no limits on borrowing, a lot of people loaded up because they could and because they had no other good option.
We're talking about a student loan crisis. So how big is this issue? How big is this problem for Americans?
Well, I think there's kind of two types of ways it affects people. One is the people who already have it, and I will say that maybe about half of the people who have student loans, it's not a crisis at all. Half of the people that have student loans, they might have 10,000 or 5,000 or 15 or something, and it's fairly affordable. And then there are some people within that don't have degrees, that went to not good schools or something, didn't finish, and that 10K is a crisis. But there are a whole bunch of people out there that it's not a crisis, it's just a debt that they're going to handle just fine. Student loans are best thought of as an income tax. The only exception to that is if you take on a bunch of private student debt, because private student debt you can't pay as an income tax. So the stuff that can really get a lot of people in trouble in the student loan world is when you take on a bunch of co-signed private student loans, and then that really can be difficult. But if you think about the federal student loan system as an income tax, everything starts to make sense, because they're going to take a percent of your income, generally 10 to 15%. And so the idea is did your education get you income that after you take away 10 to 15% of it for the student loan payments, is that net a good idea or not?
Welcome to Catching Up to Fi, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to Fi together.
All right, guys. Hello, and welcome back to Catching Up to Fi. We're recording this in December 2024, leading into the Christmas season, but you'll be hearing this in the first quarter of the new year. And a lot of you will be wondering which college your kid's going to get into as of March 15th. My nieces just got into colleges of their choice, early action, early decision, so we're very excited. But we're here to talk about student loans today with one of the national expert on student loans, and we're excited to bring him to you. But first, I want to give you a couple of shout outs. Our charity of the week comes to me from Mark Troutman. It's called the PKPCommunityCenter.org. Now, the PKP Women's Center has an overall goal to facilitate female empowerment and gender equality to Balinese women and girls in the local area. PKP empowers women by facilitating job skills training and support programs like cooking and English class. But most importantly, the Women's Center also provides a safe haven for divorced women who are generally highly stigmatized and ostracized in the community. The job training that PKP provides are proven to help families who feel stressed due to financial difficulties. The village as a whole benefits from these programs because families can use the additional money for education or nutrition. This source of income provides better opportunities for their children to create more successful futures. So at this giving time of year, although we're recording this in December, it's always a giving time of year, think about PKP Women's Center. That's PKP Community Center with CENTRE.org. Think about them in your giving plan, and you'll make a difference around the world in Bali.
Oh, I love that, Bill.
Yeah. Our second shout out today, Jackie, is for a podcast. Jackie was on this show, and we're going to give you a peek of this show on Christmas week or Christmas Day. It's called The Struggle is Real with Justin Peters.
Our friend.
Jackie, as you may remember from List Today, she played Monopoly Jeopardy.
Jeopardy. Get your games right, man.
Financial Jeopardy. All right. Last shout out, Jackie, before we get started, is this week's review. And this one comes from Tulip Tree Finance on December 5th. This podcast is a wonderful source of education. Most people are supposed to be working towards FI, whether we realize it or not. In my 30s, I knew nothing about what people meant by retirement accounts or how people supported themselves after retiring. I wish someone had explained this to me sooner, but better late than never. So, Jackie, welcome back from Thanksgiving break and back in the studio with Catching Up to Fi.
Yeah, I'm glad to be here, partner. And I am glad to have our guest today, Travis. We met at the First Economy. So he's a friend of the show, friend of mine. He is one of the, like you said, probably the best authority on student loans, especially when it comes to breaking news. So Travis is a speaker and founder of the Student Loan Planner, which he launched after helping his physician wife navigate ridiculously complex student loan repayment decisions. To date, Student Loan Planner has consulted on over $4 billion in student debt. Travis is a chartered financial analyst and a certified financial planner and brings his background as a former bond trader, trading billions of dollars. Trying to solve the student loan crisis brought him out of his first retirement at the age of 25. Yeah, so young. So he brings that same intensity to analyzing the best repayment paths for graduate degree professionals with 6 figures of student loan debt. Travis and his team have helped over 15,000 clients, save over $983 million. I'll have to ask him if they crossed over the $1 billion mark yet on their student loans. And he's been featured on NPR, New York Times, Bloomberg, Business Insider, Forbes, Rolling Stone, Choosified, Bigger Pockets, almost all of them, but a whole lot more.
And now he's been featured on Catching Up to Five.
And now he's been featured on Catching Up to Five. That's right. So welcome to the show, Travis. We're happy to have you and your eyebrows. You have to go to the YouTube version to see what I mean, but I love your eyebrows. So I want to know, have you guys ticked over the what would that be, 1 billion mark?
We have, yes.
Wow.
If you hear any kind of rustling in the background, it's actually my eyebrows accidentally brushing the microphone. So this is one of those things where in audio-only format, you're not getting the full show.
Yes.
So I help people with burdens. I was burdened with these eyebrows. We help people with the burden of student debt. So it's an exciting calling.
Well, you tweeted out there that you wouldn't cut your hair, your eyebrows, or your beard until the student loan crisis was solved. Is that true?
Well, it's a little bit of a white lie. I did trim it up because I was supposed to go to a Christmas party with the wife, and she said I looked homeless, so she won. But in general, I'm definitely a little bit more rugged looking with the stress that all of our community is under right now with the pure chaos is what I would call it with the student loan system at the moment.
Well, last thing I want to know before we get started is your last name is Hornsby, and I'm a big fan of Bruce Hornsby. Are you related in any way?
Unfortunately, I'm not. So my dad was adopted, so name came along with the territory.
Okay, well, speaking of your dad, you have a fascinating story. When you spoke at Economy, that was one of my favorite talks, with your energy, your humor. So tell us a little bit about your story. You said you retired at 25. You're not retired anymore, but take us back to that and tell us Travis Hornsby's financial independence story.
I mean, I think that it starts probably with a couple key figures in my life, right? So my grandfather, World War II veteran, very frugal person, and he gets diagnosed with Parkinson's and then kind of reveals, oh, by the way, he's like the millionaire next door type. And I was really floored by that because this is somebody that never liked ostentatious things, never spent on anything flashy. And lo and behold, he's this secret, brilliant investor. And I thought, wow, that's so fascinating. And then on the other side, I saw my dad, my mom working as a teacher and a nurse, and my mom couldn't work because of disability at one point. So it was like they were trying to save as much as they could and struggling. And then my grandfather kind of was this very frugal person who lost his house as a kid in the Great Depression. And that profoundly influenced him in a way where he was like, well, just in case something bad happens again, I want to be able to protect my family and my extended family. And so I was just very profoundly impacted by that in a couple of ways. One, on the side of my grandfather, I thought, well, even though he did this to protect his family, like he had the screws on too tight, so to speak. He could have taken some of the pressure off. He could have retired earlier. I said, do you have any regrets about your finances? And he said, yes, I wish I'd retired 3 years sooner. And so that was his one regret about retirement. And I think about my parents. My dad just sort of felt, I think, pretty stuck with his job, having 3 kids and my mom not working. And he was a teacher, didn't make that much money. So he sort of felt like he had to do the work that he did that initially was rewarding to him. But I think kind of as he got older, it was really difficult for him to show up every day and feel happy about that. And so I was profoundly impacted by that. And when I was going to school, I was like, well, I got to kind of pay for myself. And so I went out and got a lot of scholarships and got paid to go to school, which is really a blessing. But I went to a really good school, but a school that was a step below maybe what I could have gotten into in exchange for getting those merit scholarships. So that was really helpful for me coming out with no debt. And then I just lived kind of like a monk for the first 3 years out of graduation. So lived in a quasi-finished basement and drove a questionable car at times, was extremely frugal. Like, people made fun of me, but I would be at my desk, and a lot of times we didn't have enough time to eat during the bond trading hours, and so I would just bring like a thing of carrots and a block of cheese, and people thought I was a freaking weirdo, and I was. So I had this 80% savings rate, something obscene. And so I stashed away enough to be able to not work for an extended period. As many people in this movement, I found that the Mr. Money Mustache blog in the early 2010s realized, oh wait, this whole math makes sense. The 4% rule, if you get a certain number of assets, you can afford to not work, possibly for a real extended period of time. So I did consider myself early retired at 25, but what I wasn't anticipating in my model is getting married and having kids.
Boom, that'll change everything.
Kind of threw me for a loop. My wife said, yes, you're financially independent if you live in a mobile home in a rural area, but not if you want to have a normal house and a normal lifestyle for your kids. And so essentially I was started to do the student loan stuff because it was interesting to me. I had a skill set of Excel modeling, and then that allowed me to get into Student Loan Planner.
Quick time out there, because what you did with your time freedom or your early retirement, which was like a retirement pause, is also interesting. I mean, at 25, my kids are 25, they're still figuring it out. You'd already figured it out, and you exited the work building to do what, though? What did you do?
Well, I traveled for about 18 months, but I worked in a lot of projects in between that period. And so just a little bit of a background on me personally. It's kind of another kind of a weird story, but I'll just share it anyway. So I had a near-death experience. So when I was about 20 years old, I was driving home from winter break in college, and I was next to a semi-truck, and the weather was really bad. And the semi-truck threw a bunch of water up on my windshield. I couldn't see anything as I was trying to pass him on the left. And so I tapped my brakes to back off of him, but I went into a big puddle of water on the interstate, hydroplaned into a tree at 70 miles an hour. So I don't want to go into the graphic details, but definitely could have died and didn't. And so you kind of have people that go through those kinds of experiences, I think often have survivor's guilt or something like that, where it's just like, wow, I can't just do my 9 to 5 now. I have to justify why I survived when so many people don't, when they go through something like that, right? So I think I had an unusual burden psychologically that most 20-somethings don't have, that still think they're invincible. And so I also had a really bad knee injury when I was younger as well. And so the combination of those kind of things, I sort of had this, maybe call it an older man view of my own mortality at a very young age, which kind of ended up being a blessing, because that urgency, I had urgency of, okay, if you're not feeling like you're in a job that you're called to, well, then if you don't need the finances, then you have an obligation to yourself to separate yourself from that and try to find whatever it is that you are meant to do. And so that was the reason for the real urgency in my case, was just that psychology of knowing I don't have a lot of time, knowing I need to spend it in a way that I was meant to. And the early retirement thing, I did it without much of a plan, to be quite honest. And the time that I got refreshed me, because I was questioning everything about what should I do in life, all these normal things that 20-somethings go through. And that 18 months gave me space to be creative and to kind of think about what came next.
Well, you talked about your sad bond trader face, and you showed us the sad bond trader face at the economy conference. And I urge everybody to watch Travis's lecture at the economy conference. But then your sad bond trader face turned into sort of a happy world traveler face. But that didn't carry you into meeting your wife and getting married. That posed a bit of an obstacle, didn't it?
It did. Well, I mean, so my wife's in medicine. Medicine, as you know, Bill, is very hierarchical and structured, right? And so you put in your time, you advance, you have a limited number of vacation days, and you have to be somewhere. You can't just, in most cases, I mean, obviously with the rise of telehealth, there's some exceptions, but if you're a surgeon, you certainly have to be in a location. And so this idea of me being location independent, kind of a digital nomad, that did not compute with what my wife felt called to do. And we were dating at the time, and eventually had to sort of put up or shut up and figure out what I wanted to do with that. And when we both decided, yeah, we want to pursue this relationship, I was living at the time in St. Louis and essentially got an ultimatum from her dad when I asked his blessing to marry his daughter that was sort of like, go get a job or else. I was like, what's or else? And he's like, well, I won't come to the wedding because you won't have my blessing. It's very traditional. My wife's Asian American. It's a very traditional family of immigrants that didn't understand, frankly, I think, this idea of early retirement and FI, and like that wasn't their experience. Their experience was working their tails off just to make it, and just they did not understand that privilege that I had of being able to do what I did. And so essentially I was doing the student loan stuff at the time just sort of as a hobby, and it was a hobby that was making me money, but I wasn't taking it super seriously. And so when he sort of gave me that ultimatum, it was kind of a blessing in disguise, because then I doubled down on that, got more serious with it, and then Student Loan Planner really started taking off beyond myself at that point. That was around 2016 type of time frame.
So Travis, I have a question. Was the first student loan project that you worked on, was that your wife's student loans?
That's a great question. I think I probably would say yes to that. I mean, hers were the first ones that I tried to figure out. After I figured hers out, she essentially was the one that gave me the idea, hey, you should go talk to my friends that also have this problem because they're confused as well. And then I got the business model of essentially charging for the service of giving people advice on their loans. And because of the complexity, something like 95% of the time, I was saving somebody 5 figures just because it was that confusing at the time, and it still is. But back then, there was even less information out there about how to manage things. And so I was able to just get people on different repayment plans, help them be aware of how their loans worked and what forgiveness options they were eligible for, when they should consider refinancing or not. So just a lot of different things.
Let's take a step back in sort of the 10,000-foot view, because student loans have become a part of personal finance. They're an integral part of almost everybody's personal finance. And we're talking about a student loan crisis. So how big is this issue? How big is this problem for Americans?
Well, I think there's kind of 2 types of ways it affects people. One is the people who already have it, and I will say that maybe about half of the people who have student loans, it's not a crisis at all. Half of the people that have student loans, they might have 10,000 or 5,000 or 15 or something, and it's fairly affordable. And then there are some people within that don't have degrees, that went to not good schools or something, didn't finish, and that 10K is a crisis. But there are a whole bunch of people out there that it's not a crisis, it's just a debt that they're going to handle just fine. Now, there are a whole bunch of people out there where it is a crisis. So it's kind of one of those things where student debt, you can't really say it's black and white. There's all these shades of gray with it. And I would just say that there's a huge number of people out there that have 6 figures of student loans. They might have really good incomes, but they also have even larger loans. And there's a lot of people in between where you have 50,000 of debt and you're making 50,000, but it feels like this brutal bill that you have to handle, right? And I think in particular, student loan borrowers are struggling at the moment because of the way I would say this is that the government's policy over the past, really since the beginning of the pandemic, has sort of allowed borrowers to put it in their rearview mirror and not think about their loans, right? There's been almost 4 years worth of student loan pauses, and they've also extended how long the no credit reporting has been in terms of reporting to negative information in credit bureaus if you don't pay. And they've made it so that you can ask for forbearances really easily. They've made it so that you don't have to recertify your income if you're in an income-driven repayment plan. So borrowers have not felt the pinch of their student loans in many years, and they're about to certainly feel the pinch of that in the second Trump administration, and that's going to be a big thing that people are going to have to be prepared for to make sure they don't backslide on their financial progress.
Before we jump into that, I want to look at sort of prospectively, because 18-year-olds are making financial decisions they probably shouldn't be saddled with. And the parents, our generation, the late starter generation, needs to help them with this. What, in your mind, is prudent loan amount to look at based on expected income after college for both undergrad and grad school?
That's a great question. I think that the main goal of college, from everything that I've seen, the goal should be to get a bachelor's degree if you're going to go. Yeah, that's if you're not going to go to some sort of shorter term certificate or associate program with like very tangible skills. What I see happen is like there's really 2 kinds of crises, I think. There's people who never finish their programs and now they have the debt, but they don't have a degree to get them the earnings that they need to pay off the debt. That's a huge issue in the student loan world. And then there's folks that take on get tons of education, have a huge amount of debt relative to their incomes. And that's also an issue. The reason why I said it the way that I did is student loans are best thought of as an income tax. The only exception to that is if you take on a bunch of private student debt, because private student debt you can't pay as an income tax. So the stuff that can really get a lot of people in trouble in the student loan world is when you take on a bunch of co-signed private student loans, and then that really can be difficult. But if you think about the federal student loan system as an income tax, everything starts to make sense, because they're going to take a percent of your income, generally 10 to 15%. And so the idea is did your education get you income that after you take away 10 to 15% of it for the student loan payments, is that net a good idea or not? And that's what I try to refocus people's minds on a lot, because everybody thinks about the debt as this insurmountable burden. But if you know loopholes and rules and strategies for dealing with the student debt, it actually doesn't have to get in the way of your journey to FI. It doesn't have to stop you from achieving your dreams, right? There's some rare exceptions, like the private student loan co-signing situations that I mentioned, But that's the exciting part, is that pretty much if you have almost any federal student loan balance, I can take somebody's situation and show them, hey, you thought you could never retire in your life, you can actually retire at 65. Or, hey, you thought you were never going to hit financial independence ever, actually you can hit it at 45. And so you just have to kind of actually look at the rules and not let it scare you.
Do you have any rules of thumb for students going out there? Say, I'm going to be a social worker and I'm going to earn $40,000 to $50,000 post undergrad social work degree. When do I start getting nervous about how many loans I'm taking on?
So here, I'm going to try to blow people's mind with this one because I like the social worker example. So I'll give you a real life example of somebody that was a mental health counselor, okay? And this is a real interesting one because I think the person tried to do another program and then was not able to finish. And so she had 6 figures of debt from a program she was not able to finish. She goes back, gets a mental health counselor degree or master's degree, something like that, has something like 400,000 of student loans. So you might say, oh my gosh, 400,000 of student loans, $50,000 income, this woman is in deep trouble. But as crazy as it sounds, based off of the rules that Congress created, which I didn't create them, we didn't create them, right? They're the rules that Congress created them. And so it's a dumb system, but they made it. And so you might as well do what the system encourages you to do. The smart thing in her situation was literally to go back and get another degree. And that might sound really dumb, but let me explain kind of why. So she would have to take on, for a program that would accept her, another 200 to 300,000 of student debt for a PhD in a different kind of more advanced counseling field, right? Now, it's quite likely this woman was going to make about $80,000 to $90,000 when she was done with that 3-year degree. So if you go back to that thinking of student debt as an income-driven repayment, it's a tax. So if you make that 80 to 90K and you lose 10% of it, well, you're going to lose 10% of it if you make 80 to 90K, but you're also going to lose 10% of it if you make 50. And so since there is no cap on student loan borrowing, which many people say there should be, but because there is no cap and you can take out as much loans as you want for graduate or professional school, the smart thing for her situation was to go back and get another degree to make 80 to 90K and lose 10% of that instead of earning 40 to 50K and losing 10% of that while still owing a huge amount of student debt. So that shows the problem in the system, right? Because that is not a good system, like to allow schools to make huge profits for people's education and to not worry about that and not think about the negative implications for how much society has to pay that could have gone into other public goods. That's a valid concern. But imagine knowing somebody that has 400,000 of student loans with a $50,000 income is actually not in a bad position, which is crazy.
So, Travis, I have a question for you. So when you were saying that there's unlimited borrowing through the federal student loan system for professional and graduate. So for undergrad, however, there's a limitation each year. Is that like around, what, 15,000? Like, what's the amount?
It's even less. It's like 5,000 to 9,000, depending on if you're independent or dependent student. I mean, it's tiny.
Oh, wow.
And so this is kind of what happens to people is for the undergrad system, you can still access unlimited borrowing, but it has to be through the Parent Plus program. And so the Parent Plus program can cover the gap between what the student can borrow in their own name and what the school wants. And so the Parent Plus program is very expensive in terms of the terms are not as generous as the other loan programs out there, but you can get unlimited borrowing. But I will say this, if somebody is able to get the bachelor's degree, then their world opens up because you've got federal student loans you can borrow. And for folks that do the co-signed private student loans, that is the primary risk in the student loan world because those have to be paid back. They can garnish you or get in a judgment against you if you don't pay those. So those are the loans that actually are troubling. So as weird as it sounds, $30,000 private student loan is actually a lot more significant in terms of handling it than a $300,000 student loan if it's federal. And that's the weirdness of the system.
Hey, Jackie, have you ever wished that you had a financial advisor on speed dial and ready to guide you through every money decision? Someone who could help you optimize your finances, reduce your taxes, and ensure you're always on the right track? Well, with Bolden Financial Planner, that's exactly what you get, right at your fingertips.
Bolden isn't just another financial tool. From creating a detailed retirement plan to exploring Roth conversions, Bolden provides expert-level insights tailored specifically to your situation. It's designed to help you make smarter choices without the hefty price tag of traditional financial advice.
Yeah, Bolden goes beyond just crunching the numbers. It acts as your partner in planning. It helps you navigate critical decisions like how to pay down debt, how to structure your retirement withdrawals, and how to manage your investments efficiently. With its powerful what-if scenario planning, Bolden lets you test different strategies and see the impact of your choices before you make them.
And you know what the best part is, Bill? Bolden is always there for you. As life changes, whether it's a job, a big purchase, or unexpected expenses, your Bolden plan can adjust in real time, ensuring that you stay on track no matter what.
Yeah, this tool is fantastic. It takes an investment of your time, but it pays dividends. With Bolden, you don't just get a financial plan, you get a decision-making partner and control over your financial future. Start playing smarter today at gobolden.com/catching up. That's go.bolden, BOLDIN.com/catching up.
So Travis, we're mostly going to talk about federal student loans, but you mentioned private. Can you give us a clear distinction between private student loans and federal student loans through the Department of Education?
Sure. So there's really two types of private student loans. One is like you need a co-signer and you don't have a Parent Plus borrower. They don't take out the Parent Plus loans for you, and you have unmet need for your undergrad program you got to cover, right, to go there and attend there. And so you go through an underwriting process. Your co-signer's got better credit than you do or longer credit, and they pledge that they're going to be responsible for that debt if you can't pay it. And that's the private student loan. That's the kind of origination side of private student loans. Now, the other side of it is if you privately refinance your student loans. And that's kind of been on ice for many years because there's been so many 0% interest pauses going on. Why would you take a private loan if you have 0% through the government? But back before the pandemic, somebody might have a 7 or 8% federal loan, and they would basically have a private lender pay that off and take out a loan through the private lender that's maybe 5%. And so that can save people money too. Those are the two types of private student loans. And the ones that usually involve more economically vulnerable people are the ones that when people take the loan out in the first place from an origination perspective, just to attend school, if that makes sense.
Right. And so those would be taken through like a Bank of America, whatever your local bank is, credit unions and things like that. Okay, gotcha. So they wouldn't have the federal protections like
Correct.
You would through the Department of Education. Okay. So honestly, all the different, I guess, provisions and all, like for instance, the student loan pause, that's a good example. So it was 4 years, like you said. You had to have a federal student loan, maybe in some cases a Parent Plus loan, to be able to have your payments paused. But if somebody got a student loan from Bank of America, their payments weren't paused, right?
That's right. Yeah.
Okay. So big distinction there. Okay.
Right. And that shows you the example. Like name a debt that would have 0% for
Right.
4 years and no interest, no payments, nothing. Like I can't think of a debt like that. I mean, basically what we have in America is a system where here's kind of maybe an analogy. The Democratic Party wants our student loan system to be like Europe, but can't get that passed. And so there's all these loopholes to try to make it as much like that as possible. And Republicans are kind of ignore it and willing to pretend that the bad accounting is not true, and they just like to ignore it and worry about other things. That's like historically been the two systems, is you kind of have Republicans that just don't care about it, and then Democrats, you have folks that are just trying to advocate to get more free college because they believe the free college should be a public good. And so what's happened, I think, though, with the Biden administration's policies is you've got more of like a working class coalition on the Republican side and a more educated class of voters on the Democratic side in a way that wasn't like that when I first started doing this. I am anticipating that we're going to see kind of a pendulum swing against the generosity that we've seen the past few years on student loans in the coming years. And so that's one thing that borrowers that have federal student loans do need to be aware of so that they know what they're entitled to in the law and what are things that were all done through executive action that might not be available for them that might happen in the next few years.
Yeah, it sounds like there could be some change. Well, anytime there's a change in administration, but this student loan issue in particular seemed to be two very different thoughts. So, okay, when we brought you on here, the reason why our audience, we are a little bit older, I would say demographics between 35 and 55 or something like that. Now, the student loan issue used to be a hot topic just for 20 and 30-year-olds, recent college graduates. But that is starting to change where pre-retirees, I mean, people's in their 40s, 50s, maybe even 60s that are still dealing with student loans. So what happened? Well,
education prices skyrocketed. There's a lot of things that happened, right? I would say 35 to 55 kind of folks went through, I mean, they remember 2008. Like the Gen Z, even like younger millennial crowd, they have no memory of that. But I mean, we see it all the time. I saw it a lot more back when I first started, but people would go, oh shoot, the economy is in shambles. I need to go back to school. And so a lot of 20-somethings at the time went back to school to get more advanced degrees. And because the government put no caps on the cost of education and no limits on borrowing, a lot of people loaded up because they could and because they had no other good option. So tons of people, I think, during the financial crisis especially, just got a lot of education. It was expensive, and then maybe graduated, and some of them may or may not have had the success they wanted to or gotten the fast start that they wanted to with their education. And so what's the path of least resistance? Forbearance, deferment, pauses, putting payments off, right? Getting on extended repayment options that don't really cover much of the principal but only pay mostly just the interest, right? So I think that that's how we've had this growth in the age of student loan borrowers, is a lot of folks needing that extra education, wanting to go back. And then what happens is when those folks have kids in 2008, I mean, I don't want to upset anybody, but that was a while ago. I mean, I'm feeling kind of old. I remember what I was doing in 2008, and now I'm like, wow, man, Travis, you've seen some things. So 2008 is a long time. So like people could have had, man, if I could do my math right, like you've had people that are basically could have been born around 2008 that are going to college almost, right? And so when you have that happen, so that all these 20, 30 somethings taking out debt for their education or slow walking the payback of their debt because they had to. They had kids. They maybe had a difficult housing market that they were trying to get into. And then they have the kids go to school. And what happens is this is kind of how all the messed up stuff happens. Let's say your kid wants to go to Notre Dame. Let's say Notre Dame. Hopefully nobody's going to get upset with this analogy, this big Irish fan, but I'll do it anyway. So you go there and then they say, congratulations, you've been admitted. And the cost is only $40,000 a year, and your jaw drops. And maybe you have $100,000 income as a family, right? But you can't afford $40,000 a year. And they only give the child $5,000 of debt. So now you've got $35,000. You got to figure out, how do I cover this gap? Oh, well, I could send them to community college and then they can transfer to Indiana University or something like that. Or I can just dig deep and just do whatever it takes to send them to Notre Dame. And the Parent Plus loan program will give you that unlimited debt with very little upfront pain other than seeing the size of the loan. And so the parents will just say, yeah, I guess I'm going to go ahead and let them go to Notre Dame. And they go, and then they pile on that debt. And then what happens is in 2 years, the child number 2 comes along and says, wait a second, child number 1 got to go to Notre Dame. I don't want to go to Indiana University. I want to go sing the fight song too. And so then you have that child apply, and it's like, well, are you going to say no to that child when the first one got a yes? And so now from those 4 years, you have about $150,000 of student loans, of Parent Plus loans. Maybe that's not even including your own. And then you decide, okay, well, the second child, I'm just going to do the same thing. And then suddenly, before you know it, you have $300,000 of student loans. And you have a $100,000 income, but a traditional sort of Ramsey, Susie Orman kind of mindset about debt is not going to be able to handle $300,000 of debt on $100,000 income unless you want to work till 75. And the reason that the person ended up in the $300K of debt is kind of complicated, right? One is because people said yes. They didn't say no when they had the power to say no, right? But two, why do banks have underwriting? Why do lenders have underwriting standards? Why do you have a maximum back-end debt-to-income ratio on a mortgage when you're trying to qualify for mortgage? It's to try to limit the risk to the lender. That's the reason they do it. But it also has the impact of protecting consumers. It protects the consumer for signing up for a loan that they probably statistically cannot afford to repay. But there's none of those protections on the student loan systems. Why? Because the big universities make sure that they get paid, because that would have a huge negative impact on them if they had caps on loans. So it's just this real complicated system, and that's kind of why it's a mess.
Well, the more I listen to you, the more I'm hearing housing bubble, housing bubble, housing bubble. The way you described our student loan system in the United States, it sounds like a loan bubble. Are we heading in that direction?
Well, I think it is, but I don't think it necessarily poses the risks that a housing bubble does, and there's a few reasons for that. There's not a huge securitization market on student loans. It's 90-something% owned by the federal government, right? And the federal government can ultimately just print money if it wanted to and cause inflation to pay back its obligations. So the big question mark, I would think, would be if you ever do have caps on borrowing, it could put a lot of universities out of business. And so that could have a negative impact on the economy. People lose their jobs, campuses shut down. So that would be maybe the economic risk of all this. But student loans, even though they're $1 or trillion, I mean, it is a fraction of the liabilities that exist for Medicare, Medicaid, Social Security. So those three programs dwarf the worst case scenario for student loans by a long shot. And so I would just call it a significant problem that we all face as a society, as individuals and collectively. But there's bigger problems out there. And so student loans, it's sort of it could be the worst case scenario imaginable on student loans. Just kick that can down the road another 20 years and we're at $4 trillion or $5 trillion of student loan debt. and it's still not going to be as significant as some of those other problems.
Well, the cost of education has escalated dramatically over the normal inflation. I think it's inflated at 7 to 8% a year, something like that. Will that ever stop? How do we stop that kind of escalation in cost?
You have to cap the borrowing. I think that everybody likes to pretend in student loan land. So folks like to pretend that all the debt's going to be paid back when it's not. And I think that the reality is we probably need to give more grant assistance to low-income borrowers. And we should just call it what it is, which is grant assistance that people need, and make it more based off of who needs it the most. But I mean, frankly, instead, we have a system that gets sort of the assistance really, I mean, frankly, probably in the wrong hands in some cases in terms of if you care about income distributions and things like that and equity and all.
Yeah, I agree with you on that, Travis, because I always say I have like a love-hate relationship with student loans because I know that I wouldn't have been able to get out of undergrad if I didn't have the help of a student loan. Before then, I was trying to work as much as I could, but because I was working, my grant money got cut to nothing and I stopped applying. So then I had to get a student loan, which again, the grant would have afforded me to finish, but because the grant was cut to nothing, I ended up having to get a student loan. So it helped me in that regards, but we know that most people don't know what to borrow, and first generation college students, I mean, that's even worse. I was first gen, so I had no idea how much I should borrow. Most people don't if they're going for the first time. So all of that, there's a whole bigger conversation around that. But it's just so interesting. So what was the percentage of people that were over 35 that had student loans?
It's like right around 80%, I think. I mean, it's gotten really, we call it like the graying student loan crisis. I better be careful here. I'm in that, soon to be in that category. But I think that one positive thing I can say, right? So people do pay a percent of their income for the loans, right? That's how it normally works. Right. And so the government does get some of their money back, not all of it, right? I think in a lot of cases, it's kind of almost like a 0% interest loan if you run the present values of all the payback. And so it's just, again, basically we have a very complex system because of the way Congress does accounting. The way Congress does accounting, I don't want to get super into the weeds there, but they take all the interest income and they classify that as income when a lot of that interest income is never going to actually happen. And so it makes it look like Congress is making this very reasonable, balanced budget kind of thing. But it's not actually going to work out that way because the interest gets paused or subsidized. I think that probably if you said, how do you fix the problem? You probably cut off the worst programs that have the worst debt-to-income ratios. You probably cap borrowing. You probably pull back on how many for-profit schools are allowed to participate in the program, right? But all of those groups have special interests that protect them. So I think that given that all that exists, I think that you could throw your hands up. But what's a lot more helpful is to say, well, what can I do? What can I do as an individual to not let this get in the way of achieving my dreams? Right. And that's the part that's exciting to me.
Right. And what about the cost of education, like these schools and what they are charged? It's almost like I never hear that really brought up in the conversation. Bill was saying when he went to med school, it was almost nothing. He didn't have any student loans. Mine was even reasonable. But now the cost of education has escalated. So it's like, I guess at what point do we start to look at that piece?
Well, we're seeing, I think the first schools charge $100,000 plus for tuition annually. We're reaching that point.
Well, I think that if you wanted to get real blunt about it, like in economics, like they talk about consumer surplus, which is how much extra value a consumer gets relative to what they paid. And so if you think about what's the value of a medical school degree, I mean, Bill, obviously you went through a lot of pain and suffering for that, so I want to be careful what I say here.
Should I show you my scars?
I know, but say you pay $300,000 for a medical school degree. Compared to other things that someone that's smart that goes to medical school could do, maybe that's not a good financial decision. But if you compare just overall, spending $300,000 to become a physician and sacrifice your body and your life to do residency, you come out and you make $200,000 to $300,000, some people a lot more than that. If you just run the math on that, the finances on that, that ROI is really good compared to being a bachelor's degree only and stopping at that level. And the unemployment rate is lower and the stability of your income is higher. So if you think about dollar cost averaging, your ability to dollar cost average and invest during periods of economic downturn is much enhanced. And so the value of that education is astronomical compared to just a bachelor's degree only. Now, there are some programs that have very little value out there, like financially and economically, but I think what schools realized is, okay, if we give somebody this dental degree or this pharmacy degree or all these professional degrees, the value of that degree is so much higher in terms of lifetime earnings than what they were charging that they just frankly realized that they could charge more. And the only obstacle to them charging more was a lender that would be willing to pay for it, right? And so when the government tried to expand access and got into the market more aggressively and said, we want to help expand access to make sure that all people can get into these fields and not just folks that have savings and families that can afford it, that's a good thing, but schools took advantage of it. Schools just essentially knew that the value that consumers were getting from those educations were so much greater than what they were paying that they could jack the price up and nobody would say anything about it. And we are seeing some pushback in some areas, like law school. There was a pushback a few years ago on prices because the job market wasn't as good. Pharmacy school, I think there's some pushback right now with like the job market not being as good. But the only thing that stops the price escalation is either a constraint of capital that will fund it, or people having a slower job market where becoming a fill in the blank is not as attractive as just going into the trades, right? And I do think that's why we're seeing a little bit of a slowdown in higher education. It's not because of anything that's happening with Congress or the student loan market being limited. It's just because during the pandemic, people are like, wow, I can be a plumber and make $100,000 a year, or I can go to this certificate program and come right out and make $70,000 a year. Why do I need education for that, right? But what I think happens is then you have a recession, a lot of people lose their jobs, the instability of not having a high education is kind of exposed, and then everybody values education again and the schools lick their chops because they can keep raising the prices.
So Travis, let me ask you this. So is possibly part of the reason why older student loan borrowers or the average age of student loan borrowers is growing up is because now you have these income-driven repayment plans that is like 20 to 25 years if it's not the public service. Is that a part of it?
It's a huge part of it because like there's not a rational reason to pay down debt in a lot of cases, right? If I have the $300,000 of loans and $100K of income, I need to pay 10% of my income so that I can afford to save for retirement, so I can send my kids to good after-school programs, so that I can enjoy the occasional vacation and pay for my reasonable middle-class house. So people, I would say, in a lot of cases are making rational decisions to do income-based programs. And the Biden administration tried to supercharge this. They had 9 million people on the SAVE plan out of 40 million borrowers, and that number was exponentially increasing. I think if they had left that plan in place, they would have had maybe half of all borrowers paying on that plan, and then half of all the people on the SAVE plan were paying nothing.
Now, Travis, can you explain to us what the SAVE plan is?
Well, the SAVE plan, by the time this comes out, it's probably going to be the former SAVE plan. But it was the signature initiative of the Biden administration on student loans. And the goal was to simply just make it so that people didn't have to pay as much of their income towards the loans. And so it was just, they updated the formula and made it so that your first, let's say 40 to 60,000 of earnings would be, you'd pay nothing on that, and then you'd only pay 10%, or actually 5 to 10% on everything above that number. And that was extraordinarily generous compared to the past. And eventually you have this conservative advantage in the courts. Eventually elected Republicans decided to try to use that to their advantage by trying to stop that stuff. So they sued to block that, and it's because SAVE plan's not in the law, they're probably going to be able to overturn that. And what the consequence of that is just borrowers might pay a little bit more. And that's actually not something that people need to be super worried about, because there's things like income-based repayment that are written into the law. And that means that people will still be paying a percent of their incomes if they have federal student loans, unless it's a bad deal. If you have such a high income that a percent of your income would be really, really high, well, maybe it's better just to treat it like a debt and just get it onto a really sound payment schedule to pay it off. There's nothing wrong about paying off your loans. I'm very much a fan of that. What I don't like is where it's the only option, and then people let the dreams get shut down because you got to pay your loans off. And again, going back to full circle where I talked about my near-death experience, like, you've got limited time on earth. If you pay down your loans, congratulations, you'll be the same level of happiness after you paid off your loans that you were before. A lot of people listening to this podcast trying to reach that financial independence, a lot of people don't even realize, hey, you can make some changes right now that allow you to be happier, that don't necessarily involve you being fully retired and not working. A lot of people don't realize that, like kind of the Coast 5 movement, where you can not have to save anymore because you've already saved enough. Flexibilities around people working a little bit less, working part-time hours, or restructuring some of their finances to reduce the burden of their cash flow where they don't have to be under much pressure. That's stuff that gets me real excited, is people that don't have to be as stressed as they are currently, and they don't have to wait as long as they think they need to wait to get more of the stuff they want now.
And in that regard, you have a couple of rules you mentioned, the 1 to 5 rule and the 25 to 30 rule. Can you go over that for me again?
Well, the 1 to 5 rule, are we talking about just having enough that you could do something for an extended period? Yeah. So I think that a lot of folks, if you're in that lower end of the age range, the 35 to say 45 camp, a big thing that can change your life is just getting enough saved that you can afford to take 1 to 5 years off of work. It doesn't have to be something that you have a huge amount of money for, but if you can just get yourself to a point where you can take a break. My friend Jillian would call it a sabbatical. From Montana Money Adventures was her site back in the day, right? So it's like the goal is to be able to take a break, and that can be transformational because it can allow you to get some headspace. It can allow you to refresh yourself. It can allow you to avoid burnout. And maybe it's not 1 to 5 years, maybe it's just 6 months, or maybe you switch jobs or something and you build in a 3-month buffer so you can get a little bit of relaxation in. Because I know with physicians, sometimes the worry is, well, you're going to lose your skills, right? And then the 25 to 30, sometimes you say so many rules and you spout off so much you forget your own rules, right? But I think that one is just being able to afford a long-term retirement, I think is what that one was mentioning, Bill. And just being able to have enough money where if you can have 25 to 30 years of no income, you will very likely pick up extra side hustles. You will figure out ways to modulate your expenses if you need to. There's ways that you can get higher payouts from Social Security, get into the ACA, do strategic rollovers of retirement assets to hit specific AGI thresholds where you can not have to worry about health insurance and things like that. So let me know if I came up with a different rule from a while back that I missed.
That's essentially it, because you're a big fan of not letting your student loans drive the bus, letting your life drive the bus, and then the student loans will get taken care of in due course, and not doing the Dave Ramsey gazelle intense approach, because it's going to be an early retirement extreme deprivation approach as opposed to a balanced 50-50 approach, right?
Here's kind of like an example. I love examples. So one of the examples we run into all the time is somebody who's 50 years old, who has $200,000 of student loans, and maybe 6 figures saved for retirement, but she thinks she's done for. Like, she can't retire ever. All these decisions that she's made are just unfixable, and she probably even feels shame or guilt and blames herself for it. And I understand where somebody would feel that, but they don't need to feel that. And so some of the ways to counteract that, it's like, okay, well, what's your cash burn? And a lot of times these are middle-class folks in terms of their spending. They're not extravagant in most cases from what I've seen. It's really people with pretty normal expenses that face this problem. And so if this person, let's say that they're able to maybe strategically defer or forbear their loans a little bit to kind of catch up a little bit on retirement savings, and then you model out, well, what is their actual payments? Well, now we just need to figure out a way for that person to make it to 70. Well, I think there's 2 things in that case. One would be making sure you don't have to worry about healthcare expenses. So you try to do some strategic stuff to get under the Affordable Care Act if you need to, whenever you're kind of going to cut back on hours or try to retire. And then you try to avoid claiming Social Security until you've got your max benefit. And if you do those things, maybe along with kind of figuring out if there's any other optimizations on your big fixed expenses, like maybe you have enough equity in your house to downsize and not have a mortgage, for example. So if you do those kinds of things, suddenly somebody's paying 10% of their income in retirement, which might be really, really low in terms of the realized income. And then they're able to just make it to Social Security, Medicare, and then it's sort of like, well, you might not have enough money for Viking River cruises every month, but you might have a really solid retirement, and somebody thought that was impossible. And so that's the stuff that's exciting, is you have to kind of help somebody realize, wait a second, what do you want? Why do you want it? What kind of calling do you have for your life? And how do we just take this fear and this stress and this worry, which I certainly struggle with too in life, right? And say, well, let's debunk this with math. That's what I like about the world that I inhabit, is I can pretty much debunk 99% of people's student loan related worries with just pure math, and then just let it sit with people and they realize I'm not trapped anymore.
Yeah, I appreciate that.
The thing I like, Travis, is you take a holistic, meaning whole person, whole financial person approach to student loans, where student loans are often seen in a vacuum. Tell us a little bit about your organization, Student Loan Planner, because that's evolved in of itself. And you just talked about looking at the loan in toto of what your financial life is and your entire health span and work span. Can you tell us what Student Loan Planner offers people? And I'd be interested to know what percentage of the people you work with are actually these older student loan borrowers or parents that come to you with these quote unquote student loan crises.
I mean, just off the top of my head, it's probably a third are pretty recent grads, probably a third what I would call mid-career or early career professionals that are in their 30s or 40s, and then maybe a third are seniors or parents. And it's kind of, we deal with mostly people with 6 figures of student debt because that's what our paid service makes the most sense for. So our paid service is a few $100. And when you do an hour consult and then any follow-up questions you have covered for a few months after that, 3 months after that or so. And what we do is we transform the way you're handling your loans. So we help you think through what are all the loopholes you could use, what are all the worst things that can happen, what are all the best things that can happen, and here's your plan A, here's your plan B, here's your plan C. So we give you a bunch of options where it's not like just, oh, here's my plan. And so that's the sort of one-off consultative approach that we offer. And then we also started a financial planning business mostly for student loan borrowers that need a deeper sort of level of help in their finances. So a lot of people want to take it a step further and say, well, how do I, my student loans are based on my income, how do I minimize my taxable income, right, legally? How do I take advantage of actually setting up the solo 401k or the SEP IRA or the 401k profit sharing plan at work so that I can lower my taxable income and not have as big of a hit in terms of what I get to actually invest? So those are like different kinds of paid services, and there's also the free services, which is at studentloanplanner.com, and it's just a bunch of calculators, a bunch of blog articles. We have a newsletter that people like to read once a week. And so the whole dream of this was to have a whole bunch of people that can't afford us get a lot of help for free. And then the people who would lose a lot more money if they didn't use us and they can't afford us to have that paid service for folks that want it. So that's kind of what we do in a nutshell.
So if you have 100,000 of student loans, you're 50 years old, you have 100,000 of student loans, and you're behind in retirement and you're stuck. And they come to you, what kind of an ROI are they going to see out of a consultation with Student Loan Planner? And they earn six figures, they have 6 figures of debt.
Yeah, it depends on the profession. I think our average savings projected over the life of the loan, of course, some people do save the money immediately, but it's about $60,000 or so, I think, per borrower. Now, somebody who's a physician or a dentist, their savings is probably going to be more tilted towards like $100,000 or something like that. And then somebody who's maybe a social worker or a physical therapist or something, that might be tilted a little bit more towards the lower end, like $40,000 or $50,000, right? So the way we do it is just to have that transparent flat fee for the advice. And people can check our reviews to see, I don't think I say this arrogantly, right? But you read the reviews and people can make up their own minds. We do care a ton about being the best. I think that really matters in something like this, that we always want to be on the actual cutting edge of all of this. And so we are always paying attention to not only what's going to happen right now, but what's going to happen next. Because what happens with student loans is there's always next. There's always the next administration, the next program, the next plan, the next initiative. And it can make people's heads spin because it's such an unstable area of government policy because there's no consensus on what to do. So that's the approach we try to take, and I'm blessed to be able to help people with it.
Yeah, I would double down on that. I've been listening to Student Loan Planner for a long time, Travis. But like, for instance, if there's like breaking news at 3 o'clock on Friday, and then guess what? Student Loan Planner has breaking news talking about it 2 hours later. So you could tell you live and breathe this stuff. You give away so much for free. The podcast, I always call podcasts just a free classroom. And then you've got a lot of stuff on your website. Again, for people that may not need the one-on-one service, but if you do, you were generous enough to offer our audience a discount. We'll put that in the show notes. But you get a chance to kind of see what you are talking about, how passionate you are about student loan planning. And I believe in going to the more reputable sources that you know what the heck they're talking about. And you're certainly one of those people. So I do have a question. So we talked about like the regular income-driven repayment plans, the 20, 25 years, the public service loan forgiveness for our people that are government workers, nonprofit workers. That's even better, right?
Yeah, that's 10 years. So that can be real rapid. I mean, there's a lot of programs out there where people might not even realize they even have a lot of credit already because there's been all these updates. And that's one of the big questions is how much of the stuff that President Biden did will President Trump's team actually implement? And that's a big question that I would have if I was a borrower. And the good news is a lot of it will be implemented because it's just be too hard to unimplement. And then some of the things probably will be limited or restricted in this coming 4 years or so.
We're going to have to revisit this probably come February 20th after we've had a month to see how rapidly things have changed. Now, one thing I do want to do, Jackie, before we let Travis go, is talk about Krista and Ed, because we had Krista and Ed on our show to talk about their story. And one of the parts of their story, and we want to give them some follow-up, a little surprise, was their student loan history. Do you want to tell Travis about their student loans and see what he has to say?
Yeah, and just to clarify, this was a case study that was done at Econ economy, and then we did a follow-up with them on our podcast. And I'll drop the video to that in the show notes. But they did have a student loan issue. Now, I was the student loan person there because I learned a lot from you, Travis. But here was their scenario. So Krista, I believe, she was with one of those for-profit schools that I think is supposed to get forgiven. So I don't know. Any updates on that, these for-profit schools?
What a great question. I mean, I would expect that there might be relief handed out at the very last second in the waning hours of the Biden administration where they try to rush all of that through.
Like on January 19th?
Right. I mean, there's a settlement called Sweet v. Cardona where all these borrowers are supposed to have a very accelerated time frame to have all of their debt evaluated for forgiveness, and it's mostly just supposed to be forgiven. But like anything, there's some legal challenges going on, and the new administration could decide to try to slow walk that strategically to maybe try to challenge it. Because if you think about Sweet v. Cardona, Cardona was Secretary of Education. That Secretary of Education under the Biden administration wanted the settlement to go through, right? So if you get a person in there that does not want the settlement to go through, they could try to slow things down quite a bit there.
Yeah, and that brings another question. So I remember when we were talking to Krista, I don't know if you remember this, Bill, but she was saying that her reason for going to a for-profit school was because they were more flexible. She was a single mom and she could go in the evenings and things like that. So that kind of makes me think about, is there any like certain demographic groups that are more impacted by student loans than others?
Well, it's definitely, people call it a women's issue and an issue for communities of color. I mean, it definitely impacts those communities disproportionately. But like I said, a lot of the relief has just been sort of broad brush and not targeted for the people who need it the most. I mean, so I'll give you just an example is the student loan pause. If you pause everybody's interest, somebody that went to medical school that has $400,000 of student loan debt gets $30,000 a year of interest subsidies. Somebody that works at Starbucks that got taken advantage of by a program that misstated their employment find and has $10,000 of student loan debt, that person maybe got $500 of interest subsidies, right? So you might say, well, it's fair because it's pausing everybody's interest. Well, people that have more debt actually disproportionately tend to have a lot higher incomes, right? So what they did is they paused everybody's interest with this blunt instrument. But I mean, not only do they pause the interest, they also counted all the paused payments towards forgiveness credit. So what happened is a lot of folks that have PSLF qualifying employment that would normally be paying $2,000, $3,000, $4,000 a month, 10% of their incomes that are working at hospitals, like physicians, for example, they got all that paused and they got all that credited towards PSLF. And so there's a lot of, like I think the class, med school class, something like maybe 2014 or something, probably the people that qualified for PSLF have probably paid a grand total of maybe $5,000 on all of their student loans ever, like in terms of people that graduated med school around 2014. And physicians work hard. Physicians really go through a lot of abuse and difficult circumstances and deserve help, right? I'm not saying physicians don't. But the problem is just we're not thinking about what are all the downstream impacts of all these student loan policies because it's just chaos and it's not thought through and it's just sort of like broad strokes. And that's fine because broad stroke, like that's the way a lot of programs work in life because life's not fair. And so you as a person, as a borrower can say, instead of saying the system's ridiculous and I just can't do anything about it, you can learn all these rules and try to help you better yourself. And it's kind of like all the hacks you'll probably talk about, right? Mega backdoor Roths and getting the whatever distribution where you can get access to your money at 55 without penalties, right?
Yeah, 72T, and then you got the rule of 55. Yeah.
Exactly. And so obviously those things kind of help people that are disproportionately in the know. So it's like, well, you can be out of the know and not benefit from the stuff, or you can be in the know and benefit from it. And then eventually maybe they make changes. But that's one of the reasons, right, why we try to stay a lot more at Student Loan Planner. We try not to spend a lot of time on saying the way things should be. Because ultimately we know that, frankly, I just don't have a lot of impact or control over the way things are. So what I can say is what I do have a lot of impact over is helping educate you on the way you can change things for your life. And that's the exciting stuff is you just kind of have to figure out whatever's going on out there, take the best stuff that will help you, bring it in, and let's use those loopholes like the rich people do and try to help your family.
That is huge. Thank you. I couldn't have said it better. But let me ask something on behalf of Ed, Krista's husband, and then we'll let you go here. So for Ed, he was scheduled to pay off his federal student loans in 2027. Now, again, I tried to step in and did all my research. They stumped me, so I had to do some digging. So we had the question of, was the forgiveness going to be tax-free? He was not on public service loan forgiveness. This is just regular income driven, okay? So they live in Wisconsin, so they were going to have to pay taxes for the state of Wisconsin. That's one of the 3 states. But the other big question was on a federal level, wasn't there a law that said even if you weren't on public service loan forgiveness, if you were doing an income-driven repayment plan, that forgiveness, the forgiven amount would be tax-free? But does that continue after 2025?
Well, the American Rescue Plan that was put forward in 2021 expires at the end of 2025, which is where that tax-free forgiveness provision exists. And so it expires, and with a unified Republican control of Congress and the White House, they could extend it or not. And so that's definitely a risk that they would need to take. A couple thoughts, though. Do we know what their occupations are?
Yes, technology.
And then both of them do that?
No, so the husband is IT. The wife, Krista, she just went back to work. She loves to read, and now she works at a library. So she does work for a government agency. I guess it would be state or county.
And what are their big goals in life? Like, do they have any big dreams? Like, what would you say their wildest dream is? What's their biggest one?
They wanted to retire in 10 years from their case study, right?
Yeah, that was a big dream. They wanted to retire in 10 years.
10 years. And like, where are they at?
They have 4 boys.
4 boys. And then how old are the boys? What's the age range?
They're mostly like teenagers. They might have one that's like 8 or 9.
So they got college coming.
Yes, they have. That was one of their other goals. They wanted to help take care of their college.
And then do they have a significant amount of assets right now or no?
I would say mid-range as far as assets. They were definitely on their way.
Sure. Do they want to go live abroad or live in the U.S. or what's their big thing?
Probably living in the U.S. Maybe later on abroad, but the kids, while the kids are younger or going off to college, I don't think that they have a desire to go to another country.
Are they happy in life? Like, is there something that makes them unhappy?
Very happy. They're very happy.
Yeah, they are happy. They got a great love story, so that's a lot of their happiness. They got 4 great boys and things like that.
And we need to refer our audience back to that show. We'll put it in the show notes. Listen to that show. And this is follow-up for Ed and Krista, but it applies to everybody.
I think that what I'm hearing is that he shouldn't worry about the forgiveness in 2027. I mean, there's something called the insolvency rule that basically says if your debt's larger than your assets, then the debt's forgiven tax-free no matter what. So that law would still be in place in 2027. So that's if they don't have a lot of assets. If they do have a lot of assets, by definition, they could pay the tax burden and handle it, right? And so there might be some tax planning they could do. Maybe they work a little bit less in 2027, stay in a lower tax bracket. Maybe they think if there's any kind of bonus depreciation, maybe if they're involved in any kind of side hustles or something, maybe they could look into any kind of short-term rental depreciation or bonus depreciation if they got business stuff going on to not worry about the tax hit. And then for her, going for profit school, I think that she just needs to decide, do you want to try to actually go for the front door forgiveness, which is the borrower defense stuff? And then maybe she might put her application in and get a 3-year forbearance while they're figuring that out. And maybe they say no. Maybe the next administration is the Democratic administration and says yes. Or alternatively, she could just try to see if she could go for that public service forgiveness option if the debt's federal, and then also not have to worry about it. And Wisconsin is a community property state, which what that means is that's another loophole. You can basically split somebody's income 50-50 on a tax return federally. And then you can do one of 2 things. You can say, well, I'd rather use 50% of my spousal income because that's a low number, or I'd rather use my actual income showing from my pay stubs directly. And if he's in tech and she's like maybe a librarian or something, my guess is she makes less. So she could probably do that split on the tax return and then submit legally her other proof of income and get super low payments where it's not going to be much of a hit. And the reason I asked for all those other things, right, is they also could have frankly just gone back and gotten another degree if they weren't happy. And if they had been in medical something, or maybe they were like a lower middle level medical person, maybe they could take that next step up the occupational sort of hierarchy of maybe they're a nursing assistant or something like that. Maybe they want to become a nurse, or maybe they're already a nurse and they can become an MP, or maybe they're something else and they want to become a PA, right? Like you could do a lot of that kind of stuff with an extra degree if they already have a lot of debt. But given that they're in these more sort of very common occupations, right, more common occupations, I think that that's probably a way that the loans don't have to hurt them. They just have to think, okay, enjoy our boys, enjoy togetherness. I would probably recommend to them more of a traditional plan. Like if they're not already up to their eyeballs in student debt, I would probably say try to go that whole community college and in-state kind of route and try to pay it the traditional way to not take on the stress, right? But if they had way more debt, then I'd probably say, well, yeah, you probably need to think about Parent Plus, especially with 4 boys, and you want to put the Parent Plus loans in the lower income spouse's name. So you want to put it probably in the person who's in the public sector and the librarian's kind of name. Because the idea there is you could maybe work for 10 years after the youngest is done and maybe go straight up for forgiveness, or just keep it long term because the math makes sense to hold on to it long term and just treat it like an income tax. So I think that the student loans don't have to impact any of that. They've got a pretty good situation, it sounds like.
Yeah, and this is why we love Travis, okay? He just walked us through a live student loan plan. So Krista and Ed, you got a lot of food for thought. And so Travis, if someone else wants to work with a student loan planner, or they want to find you and get more information, tell us where people can find you.
You look at the show notes, right? But in this case, the discount link is in the show notes. So you definitely want to go there if you want to hire our services, because you get $100 off. So if you go into the show notes for the show, scroll down, find the link, click on that if you book, and it's $100 off our usual rates. And if you just want the free stuff, that's just studentloanplanner.com. You'll see a spot where you can download one of our calculators, like the usual trade your email for the freebie thing. And if you like the updates you get in our newsletter, you can stay on there. And if you don't, obviously you can unsubscribe. And if you like listening to podcasts, probably you do because you're listening to this. We have the Student Loan Planner podcast you can find if you just type in Student Loan Planner in any podcast platform. So a lot of options for both the discounted stuff, thanks to you guys, and then also the free stuff as well.
Well, Travis, thank you so much, because I also, before we let you go, want to know what's in the future of Student Loan Planner and what's in your future, because I'm going to nominate you for special counselor to the Department of Education and fixing the problem.
I respectfully decline the invitation. Just kidding. But no, I think in my future, I hope to help borrowers. I'm trying to be a lot more focused on the present. So one of my gifts is being able to help people look way off in the future. One of the weaknesses that causes is in my own life, it's sometimes hard to just stop, look around and say, today is a wonderful day, right? And so for me, that's one thing I'm working on, is just trying to be more present, trying to be more living in the present. And in terms of professionally, I'm hoping that I can just help people through this very stressful year of student loan chaos that I know is coming. And so people are going to be worried, they're going to be stressed, they're going to be fearful, their payments are going to go up in many cases. And we can help people. We can take down the temperature of the stress. We can reduce the burden on people's minds. So that part of things I really enjoy. So that's what we're going to be working on the next year. And if you ask me the next 5 years, beats me. I mean, hopefully I'm still here, healthy, happy, and maybe doing the last time we did the economy conference, it was right before the pandemic. So just hopefully a very healthy, happy, maybe another talk at a conference somewhere or something. That sounds good to me in 5 years.
I think that's a great place to close. Travis is here helping you to maximize the present. He doesn't want our late starters to be mired in the shame of the past, feel burdened by their student loans. He wants to unburden you so that you can live your best life now, not waiting for when the student loans are paid off or forgiven. Right, Jackie?
That is right. It's been great having you, Travis. And I know our audience will love what you had to say, because a lot of times we do get so worried about the far off future that we forget about the now. So it's been great hanging out with you. Hopefully we'll see you soon at Economy or somewhere, and keep doing what you're doing. You've been growing like crazy. So thank you for joining us today.
Wonderful to be here.
All right. Thank you, Travis. We'll see you next time. Next year, we're going to get an update on all the changes that have happened in the student loan planning arena. All right, guys. We'll see you next week on Catching Up to 5.
So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. Our social media maven is Diana Falk, and our editor is Fritz Brazard. We love them, and they keep us going.
Yeah, Jackie, I mean, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community, and we hope you love us back. If you would like to support the show and our mission to help late starters, you can do that at Buy Me a Coffee, which is a platform that allows you to make a donation. The link is in the show notes and on the website.
Check out the show notes for resources mentioned in today's show. Also, head on over to our website at catchinguptophi.com and check out our vetted resources, partners, and affiliates for discounts and their services, because we love sharing great deals.
Please share the show with others and head on over to our Facebook community to help us grow. If you prefer video, head on over to YouTube and watch the show there. We hope you've enjoyed this episode of Catching Up to 5. We would appreciate it if you could also leave us a 5-star review to help our message reach others.
And while we are financial educators that love to teach, remember that our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
So, Jackie, we'll see our audience next time on Catching Up to 5. Cheers.